Before we kick off today's episode of Macro Mondays, if you would like to take your trading career to the next level, Onyx Institute, my online trading course where you can learn fundamental and technical analysis of both the energy and financial markets, will be live and available for you to sign up and watch from next month. So please keep a lookout for that at onyxcapitalgroup.com. And if you have any questions or queries, you can email me at onyxlnd@onyxcapitalgroup.com. Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trade floor.
Another big week in the markets, plenty of volatility. We'll be looking at the recent data that's come out, much stronger data in China, better than expected, yet weaker data out of the US. We'll also look at the gold chart as the gold price surges through $3,000.
Looking at the previous week, we've seen US equities continue their downward momentum, so we'll be analysing that. And we'll also be looking at the week ahead as we have crunch meetings between Trump and Putin scheduled for this Tuesday.
So firstly, hot off the press, we had data out of China this morning. Better than expected. Retail sales rose 4% year on year, estimated to come out 3.8%. Also, industrial output jumped to 5.9%, estimated 5.3%. Fixed investment also rose from 3.2 expected to 4%. So good news there. The one disappointment was the house prices. House prices continue to fall. But we did get some further good news. China announces consumption boosting asset plan on special initiatives to boost consumption. 8 initiatives and moving policy from supply side to greater emphasis on the demand side to drive consumption. So the reaction from the market, well, you can see here the 10-year Chinese government bond yield continues to trend higher. We had a double bottom in January, February, but you can see the trend now for literally a couple of months has been upwards. So the market's saying the stimulus is coming in, it will take effect. House prices are slow to react, but as you can see from the data, we're having some positive reaction.
Yeah, I think it's no surprise that we haven't had a complete change in the housing outlook in China. It's been on the decline for a while now, and it's a very sticky thing. It's not sort of super elastic in terms of price changes and demand accordingly. But as we're going to be seeing more and more emphasis put on the demand side, clearly with this new set of sort of policies and stimulus geared up, I think slowly but surely, if the rest of the economy is mimicked in the housing market, it's going to be, a positive maybe sort of 12, 24 months in China, and you might see that house price recovery.
Yeah, interesting point. We've already discussed that we've seen retail going into gold instead of house prices. But with the policy initiative that came out over the weekend, one of the bullet points directly mentions investment in the stock market and supporting that. So maybe China's looking to align more with the US in a growing stock market, asset prices higher, consumer confidence higher, and growth there. In the US, on the other hand, well, firstly, some better than expected news on the inflation front. CPI fell to 2.8% year on year, expected 2.9. Core also fell to 3.1, better than expected 3.2. So inflation data is falling, but inflation fears are rising. You can see here, this is the 2-year yield. And you can see in the last couple of days, actually, we've had a dramatic, or I say dramatic, actually, the move lower in tandem with the equity sell-off recently is not that dramatic at all, but we've seen a small bounce towards the end of last week. We're still a long way from 3.5%, which was the low last year. But if we move on one slide, you can see we had consumer sentiment came out last week. That plunged the University of Michigan consumer sentiment. You can see from the chart here, though, this is inflation expectations. They've jumped severely. What else we saw in the consumer sentiment? The headline number dropped. Consensus was it would come in at 63. It came in at 57.9. Current conditions fell from 65.7 to 63.5. Employment expectations fell from 64 to 54.2. So pretty dire across the board, made worse by higher than expected jump in prices.
Absolutely. And, the inflation headline is an interesting one. It's bucking the trend of the last 9 months or so, lowest level since July 2024. But of course, there's so much going on in other aspects, and it's always a moving picture with the US economy, especially with Trump at the helm. We're seeing, the implementation of tariffs is going to be a fundamentally inflationary thing. And it sort of might be worth reading into this inflation headline of getting 2.8% rather than the 2.9% as expected, as a bit of a cooling of the US economy overall. And maybe the thing to look at is not to analyze this and say, oh, this has been a success of policy making in order to, curb high inflation, but perhaps people are so worried about, consumer confidence is so low, demand isn't being met, and so you're seeing inflation come off in that sense. But that's not the reason why US policymakers and US economists would be wanting inflation to be under control.
Yeah.
Lackluster demand isn't a good thing for the US economy.
And we'll see more insight to that this afternoon. We have retail sales data coming out.
Yeah.
And if you look at Chicago data recently, which is highly correlated, then it looks like it will come into the downside there as well. Well, we're on this as well. Other negative sentiment coming out the US. JP Morgan CEO Jamie Dimon said he's seeing weakness in the economy, negative sentiment. He says tariffs are causing uncertainty. And there's one thing, tariffs aren't going to do anything positive for sentiment, that's for sure. Also on the airline front, United Airlines says it's seen a 50% drop in government and related travel. It adds that it's seeing weakness across the board in travel demand. And Delta's CEO Ed Bastian, on lowering Q1 guidance, said corporate and consumer spending started to stall in February. So it's pretty negative tones coming out there from corporate CEOs. So with CPI falling, that's being led by rents falling. But you can see here a chart we've previously discussed is the correlation between the US 10-year yield, which is the orange line here, and Brent, with the white line. And you can see they are pretty highly correlated. Of course, Brent is used everything from transportation to, we could come out with hundreds of products.
Absolutely. It makes sense that they're correlated because inflation inherently sort of, takes into consideration the cost of manufacturing, of which Brent is such a, parsimonious one. But it's clearly reached this decoupling over the past few months, hasn't it? We've been seeing Brent steadily coming off, but inflation continuing up. Why would that be the case? I mean, tariff fears are definitely one of them, but considering we've seen this decoupling for the past, 6 months or so, and tariffs are only coming in now, what's the explanation for that decoupling?
Yeah, and what I find interesting is where do you think this will be in 6 months' time? Because one thing I think Trump's looking at is if they know the economy is going to weaken with the policies they're implementing, but they have the Fed as a backstop to cut rates. But if inflation doesn't continue falling and does actually start to tick up like we're seeing for the expectations, the Fed aren't going to cut rates. But again, we're getting lots of mixed signals on the inflation front. More downbeat news in the US. Small business uncertainty index surged by 21%, among the largest increases on record. Again, this is uncertainty around tariff, around Trump's policies, around Doge, and around the new government.
Yeah, I mean, it's no surprise if people aren't sure sort of where their domestic goods are going to be demanded, let alone international exports, being having supply chains scuppered, it's no surprise that uncertainty is absolutely rampant, especially amongst small businesses who don't necessarily have huge amounts of, legal documentation and representation that might allow them to fight anything. So yeah, uncertainty, understandably, absolutely ripping.
And of course, what you do if you're small business uncertainty, you don't spend, you don't hire new employees. Again, it's all negatives to the economy.
Absolutely.
The S&P's entered correction territory. Now in a short, medium-term downtrend. Will it bounce at these levels? Keep seeing people saying it's good levels to bounce. You can see from the chart, it's broken through the key 200-day moving average level. There's lots of traders in the US use that as their buy level or their stop loss, their exit. But some statistics here, CTAs are now a net short 18.6 billion of US equities. That's the lowest extreme 1% rank. They've been selling 33 billion over the last week, 33 billion worth dollars of equities. Liquidations have accelerated over the past couple of sessions with the largest 2-day degrossing in 4 years. And also the Russell 2000 is now below levels 4 years ago. So another good example of mid-cap America is really struggling here. The flip side, US retail investors have been buying. So for 28 straight days from the 10th of January to the 20th of February, they were buyers every single day, including 4 of the 5 largest retail buying days in history. And now it's selling off.
Yeah, I mean, I think this is probably an interesting case of, technicals versus fundamentals. If you were to be an investor or a retail trader, you might well think that this is a cheap level to get in at the S&P compared to where it was last year, in July or whatever, because it's unquestionably lower. So from a technical basis, I'm sure you might still see inflows of capital, and retail investors clearly are still liking it, and it's a safe haven for disposable income. However, we've been talking for the last 5-10 minutes about how dire the situation in the US seems to be. Small businesses at the very least will be, slightly cautionary in terms of their capital expenditure. I don't think it's going to be isolated to small businesses though, and you're going to be seeing, greater uncertainty amongst mid and large cap companies as well, many of the constituent companies of the S&P. So it may not be, you may not see that long-term bounce.
Yeah, a good example, the Magnificent 7 stocks, they're selling off. Only Meta is still positive year to date, and Tesla's down, at one point last week, down 55% from the highs.
Yeah.
But a good point as well is the smart money, the hedge funds are selling, but CTAs are net short. What do CTAs do? They follow the trend. And they do it in such size, they will actually, they're short as it goes down, or they'll increase their position. So if you're going in here, you're fighting the trend. It's like swimming against the stream. Absolutely. If you want to buy, I would suggest wait till you see a bounce. Again, we highlight, I use the 8-day moving average quite often, but it's moving one way at the moment. We have had a big sell-off. If you look at the Bollinger Band, it's an extreme level. We may see a bounce, but it looks like it will be a short-term bounce before the next move lower. But without a doubt now it's trending down. Credit spreads are also starting to move higher here. Credit default swaps, 5 years. But again, there's nothing nervous about this chart. If this really starts to pick up, then we'd see equities start to move down far, far quicker. So there's no alarm bells ringing in this market at the moment. As for tariffs, this used to be the headlines we talk about, but now it's down 10 or 12 slides in.
Yeah.
President Trump threatened a 200% tariff on European wines. He said, I'm not happy with the European Union, and we're going to win that financial battle. I'm surprised the euro is staying at lofty levels around 108 at the moment.
Yeah, I think a lot of people, in across a lot of industries are concerned about US-EU tariffs, and tariffs on wines aren't something that are completely unheard of, but they haven't been particularly popular for the past sort of couple of 100 years. So, it might be the sort of thing where as an Englishman who doesn't mind a drop of champagne, you can start to get some, slightly cheaper stuff imported. But yeah, for US EU relationships, things are looking not too rosy at the moment.
And he's coming out again over the weekend to talk about tariffs coming out on the beginning of April.
Yeah.
And he's also said there's no one going to be excluded from the steel and aluminium tariffs, which again is a worry for Australia, for instance. So their concerns there, the Aussie dollar's been very weak this year.
Yeah, I mean, 2nd of April seems to be sort of D-Day in that regard. So yeah, it will be very interesting to see how, especially at the start of the month and start of a new quarter, some people will naturally be looking to put on some risk. But I wouldn't be surprised if people sort of wait until all announcements are made, and even once announcements are made, seeing what the reality of the matter is.
It is. One problem is it's becoming tit for tat. So here, Howard Lutnick came out saying EU response was disrespectful, but in response, Portugal's cancelled an order for F-35s from the US, going to replace them with European F-16 fighters. They said we have to be able to count on the predictability of our allies, which is no longer the case with the United States.
I think it's a totally valid point. And, it also goes to speak, we discussed last week, European defence companies, the likes of sort of Leonardo from Italy, etc. Their stocks have been performing incredibly well because, they're dependable. And you can be sure as well that the European Union in general, I think, especially that sort of Western bloc of the EU, are going to be banding together in terms of military defence, etc.
And add to the tariff scenarios, China hits Canada with retaliatory tariffs on agricultural products, just to make sure that Canada doesn't roll over easily for the US. And fairly controversially, Steve Leisman, CNBC senior economics reporter, said, I'm going to say this at the risk of losing my job, but what President Trump is doing is insane. So there's quite a lot of discontent in the US as well. On to Ukraine. Ukraine's willing to accept a 30-day truce. Russia hit back and said they would, but basically on their terms.
Yeah, on their terms. And I think, it's not going to be a straightforward thing. And also it sounds as though America want their pound of flesh as well. And so it sounds as though US agreement with any truce and continuing to help Ukraine is totally dependent upon this metals deal. So yeah, I mean, it's shake up after shake up in this Trump presidency. And we're just seeing, escalation in so many ways. It'll be interesting to see if we do make proper progress towards this truce. But I think it's certain that Ukraine will have lost quite a large amount of whether it be land or resources or economic potential, regardless of what the finer details of the truce are.
Yeah, and with Trump speaking with Putin tomorrow, then we're going to be back at looking at the headlines again.
Yeah.
The US budget deficit continues to spiral out of control. The cumulative budget deficit for the first 5 months of the year came in at 1.15 trillion, the biggest ever, biggest on record, surpassing even the fiscal shock from the depths of post-COVID response. In the month of February, the US government collected $297 billion. They spent $605 billion. So the Doge and Elon Musk have got an awful lot of work to do.
Yeah, it seems as though there are a lot of different figures being bandied around for how much this Department of Government Efficiency are actually saving. And they have, their own website tracker that keeps, Musk will tweet or X the amount that he thinks he's cutting and saving. And when people are coming to sort of audit this, you're seeing very different numbers. And I think they're overestimating quite how much they're saving. But it's clear that US budget deficit is absolutely out of control. Been the case for many, many years now, decades now, ultimately. Something needs to be done. Tanking the economy, as Trump seems to be potentially doing, is probably not going to be a good thing for long-term tax receipts. But maybe if they curb their expenditure sufficiently, it can balance out a bit.
At least they're addressing it, which is certainly nothing that President Biden did. He just kept spending.
Yeah.
And I guess by pulling out of wars or ending the Ukraine, then they're going to reduce spending on arms and military, which is the number one. Although, Yeah.
I mean, it's tricky though as well, because if the government's reducing its expenditure on military, like weaponry, etc., and you're seeing less demand from international countries, like we saw Portugal pulling out of its F-35 deal. Who's going to be demanding US arms? And so you're going to be perhaps seeing that sort of private sector, that privatized sector of the economy really flagging in what is one of the largest areas in US spending. If the government's spending less on it, if they're providing less support, who's going to fill that void? Maybe you're going to be seeing a weaker US military.
Do you think Doge will make an impact? Or a significant impact?
Well, it definitely will make an impact. I'm so skeptical of the numbers that they're banding around at the moment in terms of how much they're claiming to have saved. But ultimately, I think Doge and what it represents is clearly like a smaller state intervention. And so whether it's Musk himself at the helm of this, I'm not sure how the Trump-Musk relationship is going to work long term. I can't really see Trump allowing Musk to take the limelight quite so much for so long. I mean, we saw that bizarre incident last week with the White House basically becoming like a Tesla dealership and Trump doing, what seemed like free advertising for Tesla. I can't see that continuing in the same vein for another 2 years or so. Trump's too much of an egomaniac for that to be the case. But I think what Doge represents, and that being cost-cutting, government spending reduction, smaller US foreign aid, etc., I think that will make an impact. They just need to make sure that their tax receipts are higher. Now, whether they get increased amounts of taxation income from things like Ukrainian mining, that might mitigate things somewhat, but that's less than putting a plaster over a crevice.
Absolutely.
It's not.
And tariff income,
it's
pretty minute.
Yeah, these are not good things for the sort of core of the US economy.
Yep. On to the dollar index. You can see the dollar index here had a nice bounce off November last year's lows. It's been a pretty dramatic move lower. Again, extreme levels. We'll see that with euro dollar in a second. Having a small bounce here while the US 2-year yields are bouncing. Again, we have the Fed meeting this week. The market is now expecting 68 basis points of cuts this year. A week ago, that was 80. So we're seeing some relief in the bond market, yields ticking higher. But I think that's just short term. As I said earlier, we have retail sales coming out this afternoon. But you can see there, dollar index definitely moving in. Longer term trend is to the downside. Flip side, in Japan, the fastest base pay gains in 32 years. Japanese wage growth now exceeds US wage growth the first time since the 90s. And the Japanese 40-year bond has hit the highest yield level ever. So obviously the yen strengthening on that. The chart here, this is a weekly chart of dollar yen. You can see there's a perfect trend line. It's rallied. The yen has rallied, dollar yen has fallen down to the trend line. We're seeing a small bounce there. It looks like we've seen the top peak of dollar yen last year. What we have now is we have the US cutting rates, we have Japan raising rates.
Absolutely. So you're going to be seeing more, the currency effect is going to be quite obvious with that. But it does look as though the Japanese economy is showing some quite promising signs. I guess it's always worth caveating that if you contextualize this long term, it's still not sort of entering a boom phase in the way that you would sort of hope if you were, a Japanese economist. But
I think a key point in the market is still short of yen for the carry trade. So there is funding investment by borrowing yen where rates were down close to 0%. And now, of course, the market's yields are reversing. So that huge trade is being unwound. We saw aggressive move last August, but now it's trending against that. So we'll see continued unwind as that trend line breaks. If you look at euro yen on the weekly, there's a key horizontal at 145. As these levels break, we'll see continued down moves in cross yen currencies. The German fiscal package finally gets the green light. The CDU and the SPD agreed with the Greens. Although the 500 billion, I think the Greens insisted that 100 billion goes towards wind turbine power rather than military defense spending. But again, euro dollar here, you can see the euro had a huge move higher. We got the Bollinger Bands on here, so 2 standard deviations. It shows that it's trading outside that. It only trades above the upper Bollinger Band 2.5% of the time. So it's a pretty extreme move. You'd expect a retracement. This is something we've been discussing. We've done some recent training with our clients in both Malaysia and Singapore. Part of the technical analysis, behavioral finance. We discussed these sort of trading strategies, mean reverting, pretty extreme levels, euro dollar. And where do you think we'll see this moving?
Yeah, I mean, it's, you know, I said last week, I think German spending had to increase from whichever government was elected. And yeah, they finally settled on it. I think power prices in Germany have been too high and costs of production are too high accordingly. So yeah, increasing affordable power ought definitely to be one of the absolute priorities. I think putting an extra 100 million euros towards wind turbines could potentially be a good thing, but I don't know. But I'm have a healthy skepticism for wind energy. What we've seen in the UK here is over January and February, we sort of reached nearly all-time high energy prices, despite having you know, a huge amount of resources in terms of wind energy. And this is because when things, you know, wind energy ultimately isn't reliable. There's no on-off switch in the same way that perhaps, you know, some of the nuclear energy or even, you know, carbon related energies have. And so you can see peaks and troughs that are quite dramatic. And the peaks, you know, when there's inclement weather and people can't have, you know, the wind turbines generating energy, that can be problematic. So I wouldn't say that this resolves all of Germany's problems, but I think it's definitely a step in the right direction.
Yeah, one thing that makes me quite sceptical about the move higher in the euro is in a month's time or less than a month, we have the tariffs we've already mentioned, is how that impacts the eurozone. I think that will, obviously it's going to be a negative impact. So I think a lot of this move higher in the euro was just the unwind of what was an incredibly short position. Onto the UK. UK monthly GDP turns negative, fell 0.1% in January. Interesting chart here as well. The UK 2-year government bond yield. You can see there's a perfect trend line. It's sitting just on that. More importantly, volatility's got lower. It's gone sideways. Which way do I think that will move? I personally think it will break lower. We're seeing signs of weakness in the UK labour force, employment weakness, and if the US continues to weaken, we have tariffs implementing, then that's going to hurt the UK economy. Central banks will be forced to cut more aggressively, so I'd expect yields at the front of the curve to drift lower.
Yeah, I think it's definitely not going to be sitting on that upward trend line. And the question then becomes, if it sort of is off that upward trend line that you can see since 2021 December, then I think, yeah, a break out to the downside on a technical trading basis would make sense. And then, yeah, looking at the underlying state of the UK economy for all the reasons you've listed, and particularly the tariff ones, I do expect this to fall off in the sort of 6 to 12 month period.
Yep. And we were just discussing the euro as well. Going back on that, the euro's gone up and yields have gone higher, but actually the market is still expecting 31 points of cuts by the ECB on the 5th of June. So the market's saying they're going to have to cut more than 25. So the market is still nervous about the impact or the strength of the Eurozone economy.
And yeah, going from trend line to trend line, I mean, one of the classic examples that we always look at is Brent. We discussed over the sort of really long-term view, there was an upward trend line with Brent from dating back to about 2008 or so. But if you look at it more recently, since about 2021, we've reached, you know, a bit of a flattening out, and we have this $69 per barrel support that Brent is currently sort of hovering around. A lot of the price action has been overall down on both an outright Brent basis, but also in terms of quite a few of the product crack differentials, so that being the products such as sort of gasoline or distillates. So they've also been coming off. But what you still have to be totally aware of are supply chain shocks. So one of the big stories over the weekend was of this Houthi attack. So the Houthis have been maintaining their attacks in the Red Sea, and US have been retaliating, attacking Houthi ships. So what we saw this morning, first thing, was an immediate spike in the flat price of Brent when the market opened after the weekend of not trading. And we also saw product cracks rallying a lot. So on the screen here, this is one of our, coming from Flux Live, this is one of our charts that marks the 92 crack. So the strength of Eastern, so Singaporean gasoline minus Brent. So this shows the outright strength in gasoline in Asia. And as you can see on this chart, we saw a sharp uptick in the crack differential this morning on the 17th of March. And I'm expecting that momentum to sort of carry on. We saw spreads in 92 rallying, we saw cracks in 92 rallying, and a lot of people seem very worried that the Houthi US sort of fracas is going to continue. And I would suspect all of that is going to be really, really detrimental to supply chains, etc., will have an increased price effect. So yeah, I think especially in the Far East, but also perhaps in Europe, you're going to be seeing these product cracks rallying. So yeah, I mean, for anyone out there who would be interested in taking a view on this and trading these, I would highly recommend that you go to Onyx markets, where you'll be able to trade in an affordable and transparent way, and you'll be able to put positions on in the product cracks.
Moving on to private equity stocks moving aggressively lower in tandem with the Magnificent Seven stocks. You can see here the likes of KKR, Carlyle, Apollo down between 20 and 30%. Pretty aggressive moves in private equity. The flip side, where does money go when it's looking for a safe haven? Gold has broken above 3,000. We discussed it on the World of Oil Derivatives early last year, January, February. We had it as a trade that if gold breaks above 2,080, it was a clear buy, a long-term signal. Well, now it's breaking above 3,000, and Jeffrey Gundlach, known as the Bond King, has said it's going to reach 4,000. He also says he puts the probability that the US is going to hit a recession as 60%.
I mean, I think with gold as well, the inflation trade, even though US missed its inflation expectations, 2.8% is still enough of a signal. People were still anticipating inflation, as we saw. So you're going to be seeing flows going in as people are worried inflation expectations are high, gold's a buy. And then I think, just the economic uncertainty around so much of, especially the Western world, but even in China, the Chinese have been good buyers of gold in the recent history. Central banks have been buying. So I think it makes sense to get into this. When uncertainty is so high, people flock to the safe havens.
Yeah, we've seen, central banks buying, retail buying. I took this chart snapshot 2 hours ago. It was briefly under 3,000 then. In the last 2 hours, it's surged back above. The markets are moving pretty quickly at the moment. I'm sure we've missed a couple of Trump tweets in that time as well.
Yeah.
Bitcoin, again, with other risk assets, it's in a medium-term downtrend. People keep talking about when to buy Bitcoin, similar to, is this worth buying the dip in S&P? Well, they're trending down without a doubt. Support really comes in at 73,000. That's the last previous peak you can see there. But it's going one direction at the moment.
Yeah, I think when it hits 73,000, Trump will make some tweets and it might pump it a bit again. But yeah, the momentum is all down here.
So central bank OIS pricing, we mentioned we have the Fed this week, we have the BOJ this week. Nothing expected from the Fed, but expectations have moved down from 80 basis points of cuts was expected a week ago. Now it's 68 as the yields moved slightly higher. The first full cut is expected on the 18th of June. Bank of England, 60 basis points of cuts this year. Again, June is the next move priced. ECB is expected to move in June as well. Lots going on there. BOJ, 29 basis points of hikes priced with terminal rate this year at 77 basis points. Couple more charts. We've been highlighting Tesla. It's been in a clear downtrend. It's bounced, but you can see here the resistance is the two previous peaks, $271. It's still in a downtrend. We need to see how this week turns out. There's a slight bounce came into the markets on Friday, but it's right now it's 50% off its highs. That's a huge loss. Yeah,
and there seems to be a lot being done to try and support it, as we mentioned, the car show in the White House, but there was a bit of a bounce, but it's still off that support level, isn't it? The resistance level.
And clearly it's being massively outperformed by BYD, selling significantly more cars, significantly cheaper. I think Tesla's big hope is driverless autonomous driving.
Yeah.
And on to JP Morgan, interesting chart here. I mentioned earlier how US equity traders like the 200-day moving average. You can see it's bounced right on the 200-day moving average at $225.40. Also, that's exactly the low of where we had a break back in the latter half of last year. Significant technical level there. Again, we like our technical analysis here at Onyx. We have some online courses that will become available next month. So keep an eye out on our website for that. But certainly a big level on JP Morgan here. One of the big stocks to keep an eye on. What's out this week? We have retail sales today out of the US. Key barometer of how the consumer's doing. We've highlighted before record numbers of people being forced to take on second and third jobs. Lower incomes certainly struggling. Tuesday, we have Eurozone economic sentiment and US housing starts. Wednesday, Bank of Japan and FOMC rate decisions. Also, New Zealand GDP, that's a country that's been having to cut rates the most aggressively of the G10 countries. Thursday, Bank of England rate decision, nothing expected there. Australian employment and US leading economic indicators. And Friday, US consumer confidence. Yet again, I think that the data is going to be outdone by tweets. There's plenty of volatility in the market. Any closing thoughts?
Yeah, I mean, just looking at Monday and Friday, retail sales out to the US and consumer confidence out to the US, I'd probably stick a $5 or a $10 that these are going to be negative numbers. Like, this is not, a time of great consumer confidence in the US. But if I'm wrong, and I think if, a large number of traders are proven to be sort of wrong and retail sales come out to the upside, consumer confidence comes out to the upside, then maybe that could be your signal. You might see some support in the S&P. And if you're, someone who's looking for a point to enter, as you mentioned earlier in the show, going with a bit of momentum, that could be a good entry point. There's a lot of, tradecraft that can be thought through at these various points, but these are going to be important headlines, and it's well worth watching the data in the week to come.
An important point on tradecraft there, it's important to see how the market reacts to the data. Friday's a great example. University of Michigan consumer confidence incredibly weak. S&P jumped and yields started to tick higher. So is this green shoots of recovery? Is it a short-term bounce? It looks like it, but how long will it last with overall negative sentiment? Interesting week ahead. Hopefully you've enjoyed Macro Monday this week. We will see you next week. Thank you very much and have a great week.
Thank you.
Thanks for watching. If you would like to take your trading career to the next level, Onyx Institute, my online trading course, where you can learn fundamental and technical analysis of both the energy and financial markets, will be live and available for you to sign up and watch from next month. So please keep a lookout for that at onyxcapitalgroup.com. If you have any questions or queries, you can email me at onyxlnd@onyxcapitalgroup.com.